the NAIOP Solution Series, and my name is Sheila Vertino. The main goal of the Solution Series is to provide you in a very short time period with some fresh insights or practical tactics, positive strategies, things to help you succeed in today's tough business environment. As always, we encourage you to drive the content. Let us know what kinds of topics and presenters you would like us to arrange for in the future. I'd like to thank our sponsor today, which is the Harvard Business School Real Estate Executive Education Program. Their executive programs are designed to help seasoned and emerging leaders protect their assets and manage complex projects. In addition, participants will gain the skills they need to navigate global markets and capitalize on new opportunities. For more information, please visit their website at exed.hbs.edu. Next slide, please. As I mentioned, the Solution Series is great for quick bursts of information, but some topics need a more in-depth discussion. And for that, NAIOP has our 90-minute webinars. The next full webinar, as you can see on the screen, is going to take place on Thursday, May 27th. We have Christopher Lee, and he is going to identify 12 strategies to prosper in the months and years ahead. If you have never seen a Christopher Lee presentation, I really encourage you to sign in for this one. This is a guy who will show you how to make lemonade from lemons. He is a terrific, positive person with wonderful insights into the industry and truly how to prosper. The cost for this webinar is $65 for NAIOP members, $95 for non-members. If you'd like to register, you just go to naiop.org/webinars. And now, let's get on with our Solution Series program. Next slide, please. With us today, we're pleased to have Benjamin Breslau, Senior Vice President, Director of Research for Jones Lang LaSalle. In this role, Ben is responsible for managing a team of 40 analysts covering markets throughout the Americas. He sets the firm's statistical methodology, leads the firm's in-depth analysis of real estate markets, and oversees delivery of the firm's leading research reports and capabilities in the Americas. During his 12 years in real estate research, first with Spalding and Sly, and now with Jones Lang LaSalle, Ben has directed research for local markets, industry sectors, national and global programs, and investor and corporate clients. Welcome, Ben, and thanks for being with us today.
Thank you, Sheila, and I'd like to add my welcome to everyone. It's a pleasure to be with you all today, and I hope in a very brief 20 minutes or so to show you all some of our insights into the market and some of what we're tracking and looking for with market conditions now and looking forward. To start, I'd like to give you a sense of the economic backdrop that we see and some of the indicators that are underpinning our market outlook. We've clearly moved from the Great Recession into what I think will be a not-so-great recovery, unfortunately, but nonetheless, the indicators are much more positive than if we had been giving this presentation 6 months ago or a year ago, including more stability in the financial markets and the banking system overall through great effort of the federal government and central banks around the world, although some of that has been called into question recently with what's been going on in Europe. Businesses broadly are performing better. Corporate profits are up, and businesses, while not yet hiring substantially, are starting to spend on things like equipment and software, and we think that's a positive early indicator. GDP growth and job growth, for that matter, to some extent, are starting to not only trickle into the economic indicators on the positive side, but to become slightly more widespread and sustainable, meaning that they're not just fueled by the government spending and stimulus, but more broad-based and inclusive of private sector portions of the economy. Personal consumption actually was the biggest driver of GDP growth in the most recent preliminary reading for the first quarter. Of course, that might be revised, but we think that's a good sign. And in the job growth category, professional and business services were actually the leading contributor to job growth in the surprising job growth number that was released preliminarily in April. So those are all good signs. And of course, other segments of the economy that have been beaten down, like manufacturing and housing, are also starting to stabilize. So that's the good news. The reason we think this is, unfortunately, probably going to be a not-so-great recovery as opposed to a very robust recovery is, firstly, that historically economic recoveries and expansions that follow debt crises like we just had are muted and more moderate than average. And there are some specific things we're looking for that we believe are risks to the recovery. We do think that the recovery will be sustained, but that the upside will be lower than it otherwise would have been because of some of these risk factors. The primary one, and hitting close to home here in the U.S., is consumer confidence. Job growth is starting to return, and businesses are starting to spend, but consumers at large, despite the contribution to Q1 GDP that I just mentioned, are still delevering, still getting out from under housing debt and credit card debt, still have savings levels that are probably lower than they should be, nervous about the stock market, the sustainability of stock prices and the rebound there, and overall the level of consumer confidence and therefore the expected level of spending is still lower than we'd like to see it at this point in the recovery and overall fragile. And unemployment is expected to remain elevated, and that will contribute, we think, to a continued fragile nature of consumer confidence and consumer spending overall. The other two things I'd just highlight quickly as risks are a bit more macro. One is the sovereign debt risk that has rippled through the markets, the financial markets overall, and certainly stock markets over the last couple of weeks. There were some crises brewing in Europe in particular, with Greece, Portugal, and Spain at the forefront of that, but not the only countries in trouble. And the European Central Bank and the IMF just delivered a massive bailout, for lack of a better term, package to try to delay some of that pain. But the bailout really doesn't solve the underlying solvency issues there, and we still believe that at the very least, Europe will be looking at very slow growth and a lower euro overall as compared to the dollar, and those are things that can drag on U.S. growth. And closer to home within the U.S., again, we do see some policy risk just within the United States in terms of how the Federal Reserve and the government will remove the massive stimulus, both monetary and fiscal, that has been injected into the economy to try to boost growth and accelerate the recovery, and also what they'll do with interest rates, which currently are low, as is inflation, but the path out of this intervention from the government and the central bank is going to be a tricky one, and therefore we feel like is another important risk factor to cover. So overall, we're looking at the stimulus and government intervention having worked that started in late 2008, early 2009. If you look at a little bit of a timeline of what that means for real estate, so we see some positive economic growth and do expect that, at least in the U.S., will be somewhat sustained. But unfortunately, the real estate market and the office market in particular, which we're going to talk about in a minute, is always the caboose of the train, and people sometimes forget that. The train never always comes into the station at once, unfortunately, and although positive indicators are creeping into the picture on the economic side, employment is just barely turning positive, and we need to see sustained employment growth before we really start to see positive demand impact on the office market in particular in terms of tenant expansion. And we think the sequence of events will be something like this, where you see employment growth starting now and real sustained tenant expansion being at least 12 to maybe even 18 months away in terms of generating positive absorption for the marketplace. So actually some positive news compared to what we saw a year ago or 6 months ago, but still a little ways to go to get the real estate markets really to respond positively to the economic growth that's occurring. So I want to talk a little bit, before I talk about the office and industrial markets specifically, about industries that we see leading and lagging. Oftentimes people think in terms of geography. We think actually that the recovery will be somewhat uneven. So the downturn was highly synchronized. The recovery, we think, will not be. There'll be a variable speed, both globally and domestically in the U.S. Recovery, where capital markets will be leading, fundamentals will be lagging, and within the fundamentals across geographies, certain industry sectors in the short term, in the next 1.5 to 3 years, are more likely to drive growth and improve market conditions more than other industries. So a couple that we just at a high level see in growth mode already are energy, certainly, and not just typical oil, and also becoming somewhat typical to gas, natural gas, which impacts, oil is, everybody thinks about markets like Dallas and Houston, but natural gas certainly has impacted Dallas as well, but also markets like Denver and Pittsburgh. And in the energy realm as well, we're seeing activity, though, from smaller companies in high-tech corridors where clean tech and green tech companies are really starting to emerge and make an impact in certain submarkets from a real estate perspective. And Silicon Valley is one example of that. Certainly the health and education sector, which has been, along with the federal government, a stalwart of stability and even some growth throughout the economic downturn, we see continuing to be a factor. Despite the healthcare reform, which has introduced some uncertainty into the broad healthcare arena, we believe that the end user demand fundamentals for healthcare and for biotech, for that matter, which you also see on this slide, are better than in almost every other sector. And certainly you see a handful of markets that we expect to be impacted by those industries in a positive way. Technology overall, I mentioned before that companies are starting to spend, even though consumers still remain somewhat hesitant. But capital spending by companies is largely a replacement game, more so than net new additions to technical and stock and new equipment and software. And after putting off any sort of replacement, upgrade, improvement type spending over the last few years because of the recession, we believe that there will be a sustained increase in business spending on investment in software and equipment in particular, and that will impact the technology sector. And the U.S. government, the federal government in general, certainly a clear positive impact in markets like Washington, D.C. and Baltimore, but you see a few other markets where the federal government has a significant presence or has had an impact recently in terms of positive activity. And we do expect the federal government to need to pull back and probably, like you're hearing in Europe, implement some austerity measures, most likely after the midterm elections coming up. But we do believe that the federal government in the short term will continue to be a net growth mode in terms of occupancy. On the flip side, and you'll see some of these play out when I show you our property clock in a minute, which will be the focal point, there are some sectors and issues in certain geographies that we believe will be lags and drags on the rate of not only economic growth but real estate improvement in the office and industrial markets. Markets that generally went through the big housing boom and bust still are struggling. In some cases, the markets that fall the fastest also rise the quickest. In this case, we don't expect that to be the case. Housing will recover and has stabilized, and we do believe it will begin to recover, but it will happen slowly, and markets like Phoenix and Las Vegas and Southeast Florida and Southern California were so dependent on the mortgage, housing, construction industries that we expect the economies to be slow to recover in those markets. Finance and banking, and just an obvious submarket there is downtown Manhattan, where we're starting to see stability in Midtown Manhattan. Downtown Manhattan certainly is dependent on the financial services sector. I was there yesterday, and the expectation is that vacancy could continue to rise substantially in downtown. And a market like Charlotte, which relies on banking as well, we expect to see a lag in terms of the recovery. Some diversified economies that typically are cyclical but don't have real strongholds in any of the growth sectors that we're seeing and that I mentioned on the previous slide, we expect to be somewhat lagging or at least middle of the pack in this recovery. I think Atlanta and Chicago as examples. And then last but not least, on the lagging side, we do expect that there will be some major issues with state and local government budget deficits and debt loads that will impact not only the ability of those governments to provide services, but also the tax levels in those economies and the ability for them to provide incentives to stimulate growth and recovery. And California and Illinois, I think, probably are two of the poster children for state and local budget issues. So all things to consider when you're looking at, we believe, when you're looking at office and industrial markets or real estate in general in terms of the pace of recovery and performance. So with that, I want to introduce those of you who haven't seen it to our property clock. What you're looking at now on your screen is the office property clock for the U.S. Just to orient you, the property clock is a tool that we use visually to show where we see individual metro markets in the property cycle. So if you think of a typical sine wave property cycle that has 4 parts of the cycle, the rising market, the peaking market, the falling market, and the bottoming market, we've turned that sine wave around on top of itself and created just a clockwise movement around the property clock that you see as markets move through each of those cycles. Markets generally move clockwise, and they do in fact move at different speeds and sometimes jump around depending upon either economic or supply shocks in any of those given markets. So what you see here is, and broadly speaking, given the way the clock is oriented, the left side of the market with rising and peaking market conditions typically includes low or declining vacancy, increasing rents, and landlord-favorable market conditions. The right side of the clock, which is the falling and bottoming market, typically includes high or increasing vacancy, declining rents, and tenant-favorable market conditions from a leasing leverage perspective. Unfortunately for all the investors, landlords, and developers on the line, all of the markets remain on the right side of the clock. In 2006, 2007, just about all of the markets, with the exception of maybe a market like Detroit, would have been on the left side of the clock in the rising market. Now we see them all on the right side of the clock. But as you can see, and this is actually a bit of good news, I think, given where we are in the cycle and what I described in terms of what we see on the economy side, is that the first markets in this cycle are approaching the bottoming phase of the cycle. And what that means is that vacancy is stabilizing or at least nearing peak. Rental rate declines have, for the most part, run their course, reaching the bottom, and that new supply has entered the market or is imminent, and there's not a lot of new construction in the pipeline. And so we expect those markets to be the first to recover. And clearly there are still some markets that are lagging that as well. So at the head of the pack, and this probably shouldn't be surprising given some of the industries that we just mentioned liking and seeing growth in, you see markets that, the first 8 or 10 markets there are all markets that have strength in either the federal government like Washington, D.C., which we've seen both from the capital perspective and from the tenant activity perspective be on the leading end of the demand revival, and we expect Washington, D.C. to continue to outperform other markets this year and into next. See markets like Pittsburgh, Houston, Dallas, San Antonio that have energy or federal government. Baltimore is another one with the federal government. And then in the middle of the pack, you see some of those markets like Chicago, Atlanta, Los Angeles, Phoenix that have one or more of those lagging indicators that I mentioned. And at the back of the pack, you see either markets from the industrial Midwest that have been on this right side of the clock for almost the past decade, like a Cleveland or Detroit, where there's been a broad under-demand for an extended period of time. And then you also see some of the housing bust markets that have also had some oversupply, like Miami, that are clearly lagging, and we expect the leading markets to begin to grow and maybe even see some initial rent growth in the prime Class A end of the market by the beginning of 2011, and the lagging markets potentially to have 2, 3, maybe even longer years in terms of reaching the full bottom and beginning to recover. Overall, we have seen an increase in activity in the marketplace, but it hasn't yet translated into positive net absorption. Most tenants are out there taking new space and taking the opportunity to upgrade space, but not taking more space than they're coming out of, and in many instances using it as an opportunity to not only negotiate favorable terms, but to give up space that was either shadow space or that was just excess in their portfolio. And so we believe transaction activity will continue to increase, but the net absorption will not turn positive, and rents won't fully stabilize and start to grow until early to mid-2011. If we take a look from the office property clock over to the industrial property clock, you see a very similar array of markets in terms of where they are on the clock. The industrial market's a little bit dicier in terms of reading the clock literally from front to back, and the reason is because the industrial market, given the structural downtrend in manufacturing over the last decade plus, has had several markets that never really made it, other than maybe the very high-end, large Class A distribution portion of the market, to the rising and peaking market in this last cycle. So you have some markets like a Cleveland and a Columbus that you see sort of toward the front that actually have been there for.
Ben, this is Sheila jumping in. Go ahead and advance that slide. We're still seeing the office property clock.
Okay, it's on my screen as the industrial one already.
Okay.
Sorry about that, everyone. Why don't I just continue and talk through it?
Sure, go ahead.
I just advanced it forward a couple more, too, to see if that would make a difference, but I'm on the industrial clock now. I'll just continue to talk through it, and if people want to take a look afterwards, I'll kind of give a visual description of where markets are. The markets generally, for those of you who can't see it, and I apologize for that, are arrayed in approximately the same positions from about 1:30 on the clock at the lagging end, which are markets like Las Vegas, Los Angeles, actually, despite it being a strong port market, and Charlotte, that have a long way to go to recover, to markets at the leading end, some of which include some of the markets that I just mentioned, actually, which are not leading in terms of recovery, but have been at the bottom for a long time. But markets like Philadelphia, Dallas, the East Bay in Northern California are markets that we've seen some increased activity. And even a market like the Inland Empire, which was really a mess after the recession and substantially oversupplied, rents have come down far enough that we actually have seen some real increase in activity in a market like the Inland Empire, and believe that those markets in particular, the Inland Empire, parts of Dallas, and Philadelphia, Harrisburg, will be among the markets that are the quickest moving, not necessarily imminent broad-based recovery, but among those that will be the quickest moving. Where we've seen the most activity on the industrial side is in large Class A distribution facilities. So again, tenants taking the opportunity to upgrade space, and in fact, in some markets, there's even a little bit of concern that really high-end distribution space may dry up rather quickly in some markets. Not a broad-based recovery, but at least at that high end of the market, being driven by all sorts of different industries, including even in the most recent quarter some growth on the distribution warehouse side from the retail sector, which is a bit surprising. I'm going to click to the next slide here, which is the last one actually, and talk just a little bit about occupier strategies in this downturn. And we believe that not only looking at the overall fundamentals of a market and where we are in the cycle is important, but really understanding the nature of demand and understanding strategically where large corporate America is in terms of their occupancy planning. And it's interesting that corporate side of the business from a real estate perspective is becoming much more sophisticated. Portfolio strategy and corporate real estate strategy is becoming a more sophisticated process and program. And so understanding where corporates are coming from really, we think, is an important factor in understanding demand and understanding the outlook for the marketplace. Two sort of opposite ends of the spectrum things at work here. The first is that this is a really challenging time still for tenants, and the fact is that most tenants are sitting on more space than they need. They are in cost-cutting mode still, and CFOs are looking at commercial real estate, at the corporate real estate portfolio as one of the contributors to that cost savings. And they're very focused on flexibility. So trying to figure out ways to cut costs, to right-size their portfolio, meaning get the amount of space they need in the places that they need it for what their business has become as opposed to what it was in the past. And then how to create flexibility so that they don't get caught in this situation again in the future where a downturn hits and tenants are sitting on lots of excess space, don't have any way out, and are in what really ends up being sort of illiquid positions in terms of their operating expenses. And in the future, with lease accounting changes, which will end up hitting their balance sheets as well. So I think there's an important point here for the investment community in general, and that is that we expect vacancy to be relatively high in the near term, even as the recovery starts. Competition will continue to be fierce for tenants, and flexibility is an important factor for most large tenants. So anything in terms of the lease terms, economic or non-economic provisions that you can provide to a tenant to make your properties more flexible in their eyes, and the term flexibility might be a little bit different depending upon what tenant or what company you're talking to, but that we think will be a competitive factor in terms of where tenants decide, and in some cases may even trump cost ultimately as one of the most important factors. So with that on the downside, on the positive side, there is a huge opportunity in this market for tenants. So tenants that do have stable business plans, clarity in their business outlook, are certainly looking at this marketplace as a huge opportunity to upgrade space and location, to go long on core leased facilities, and even to acquire assets in some cases at what they believe is a deep discount. And balancing that is going to be, and how that plays out in certain markets will be critical, we think, in terms of the nature of demand and the ability of landlords and investors to compete and get in front of that demand effectively. And with that, I will conclude my 20 minutes of fame this afternoon, and I appreciate everybody's time. And I've gone to the last slide here, which shows my contact information. I'm not sure if people can see it yet, but if not, hopefully we'll circulate that. Happy to follow up and answer any specific questions that any of you may have.
Thank you, Ben. That was a really interesting presentation. The use of the clock is a very clever way to graphically display and with enormous clarity where the markets are. I think there's also a positive aspect to it because of the time marching onward. So we do get the sense that even if we're not in the right place on the clock right now, eventually our market might get there. So I want to thank you for that presentation and for sharing Jones Lang LaSalle's insights on the state of the office and industrial markets. I'm afraid we did have some technical difficulties today. We might have lost some internet connectivity. We will have we have the audio of the presentation, and Ben has agreed to make PowerPoint of the presentation available to anyone who wants it. So when Sandy sends around the information later, we'll put some extra information in there about how to make sure that you get those slides. Also, the presentation will be available by close of business today in an archived version at the NAIOP corporate website, which is naiop.org. If you click the large button on the front page that says Solutions Series, that will take you right to it. Our next Solution Series program will be on June 2nd, and we have Tim Madonna, and he's going to be talking about streamlining the commercial leasing process. So the idea there is obviously saving time, which will save money. If you have other topics that you'd like us to consider and somebody that you think would be a good presenter, please go ahead and note those in the session evaluation survey that you're going to receive after the program. Thanks again, Ben, and thank you all for attending. Goodbye for now.